Rohr here with an early global view on Tuesday, September 16th, 2014. It's currently 6:45 a.m. U.S. Central Time, and we have switched over to the December contracts on the financials, and that's important, and you can see one of the reasons why we stayed with the September so long, September S&P, up until the later part of last week, because the trading switches over so much all at once you actually get out toward the end of the second week, and this is apparent in the very nominal trading previous. And we'll have more to say about that in the actual analysis. And there are quite a few macro influences which have put the equities back under pressure. So what does all this mean to how the markets are behaving currently? And looking at the short-term view of the S&P 500, again, we've switched over to December. We want to highlight that same head and shoulders pattern. Now, of course, it's only visible here in a very nominal and sketchy sort of form, but this trading low at 1982 would be the basis for the real neckline. Problem was, as we got out into the Friday the 5th period, this was so thin it missed the full dip back down to right about the same area as that previous trading low, which was apparent in the September contract. So while nominally the neckline of this head and shoulders, left shoulder, rather distended awkward head, and somewhat more prominent right shoulder, nominally we have to use this low and give this upward slanting neckline. In truth, the equivalent inferred neckline, based upon the assumption that in a more liquid market we would have traded right back down around 1982, is indeed 1,982 in the December futures, much like the 1,989 down break in the September contract that expires this Thursday. And using that, of course, we had the down break last Tuesday, and then Wednesday we got the squeeze back up above it, pressure going back to last Thursday off the higher than expected U.S. initial jobless claims, but that didn't stick. But as we got out into more concerns about the weaker data in Europe, possible geopolitical issues, etc., by Friday the market was indeed trending back down below 1982, and that has an objective. Again, this is a minimum projected level it should hit of 1964. So that down breakout has an actual projection with it of 1964. Of course, the problem for anyone who's trying to stay friendly to the S&P is the longer that this market defends the 1982 down break and heads down to 1964, by later this week, that would mean that you're well back below your 1975 to 78 congestion area. Now it looks like in the December contract we are now below that and respecting it as resistance. But remember, the lead contract September is trading at approximately an $8 premium, so it is actually, as this has been down into 1970 area low here, has actually held against the top of 1975 to 78. So sometimes the expiration rollover displacement doesn't mean very much. In this case, though, it probably will mean quite a bit, and we will have to keep an eye on where this market is back above 82, which would be quite a strong sign, or headed down toward that lower objective. That would be pretty weak. That's it for the short-term view of the S&P 500.